Herzlich willkommen zu unserer heutigen Sendung aus dem Energiestudio in Berlin. Wir wollen Ihnen heute den aktuellen Gasmarket-Report der Internationalen Energieagentur vorstellen. Mein Name ist Charlie Grüneberg, ich leite die Kommunikation bei die Gas- und Wasserstoffwirtschaft. Und den Report werden uns die IEA-Experten Gergely Molnar und sein Kollege Frederik Ritter vorstellen. Mit dem Report zum ersten Quartal ziehen unsere Experten gleichzeitig eine Bilanz unter das Jahr 2024 und werfen einen Blick auf die Versorgungssicherheit in der EU nach dem Auslaufen des Ukraine-Transits seit dem 1. Januar. Wir werden in den kommenden 60 Minuten aber sicherlich auch mehr erfahren über die Entwicklung der internationalen Gasnachfrage und die Entwicklung der globalen LNG-Angebote. Die Veranstaltung wird wie gewohnt aufgezeichnet und im Nachgang auf unserem YouTube-Kanal veröffentlicht. Wir senden Ihnen die Präsentation der beiden Referenten, den Link zur Aufzeichnung und auch den Report später zu. Wenn Sie Fragen haben im Verlauf der Veranstaltung, was wir uns natürlich wünschen und worüber wir uns sehr freuen, dann nutzen Sie die Handhebefunktion oder schreiben Sie Ihre Frage in den Chat. Now I will switch to English, and I'm very happy to have you, Gergely, here with us, and also a warm welcome to your colleague Frederik Ritter. We are very interested in the latest developments in the gas market, not least because US President Trump has just taken office and has already expressed his view that Europe should import more gas from the US. So, Gergely Molnar and Frederik Ritter, the floor is yours.
Charlie, many thanks for your kind words of introduction. And indeed, it is a great pleasure to be here today and to join our, I would say now, traditional guest webinar. As you mentioned, we just published a few days ago our latest quarterly gas market report, which gives an overview of the market trends in 2024 and provides a short-term outlook for 2025. And on the cover, we have this wonderful LNG carrier, which has been delivering the very first LNG cargo from Plaquemines LNG to Germany, Wilhelmshaven, in the very beginning of January, which and we will discuss later in the webinar. We see that this tie between the United States and Europe in terms of LNG trade is expected to very much strengthen in 2025. The presentation itself is building very much on the structure of the report. First, we will start by providing an overview of the global market trends. Then we will provide a greater focus on Europe, which then will be followed by an overview of the Asian markets and on the most recent LNG market trends. So without further ado, let us have a look on where we stand in terms of global gas market dynamics. And one way to look at that is really to take the pulse of natural gas price movements. Natural gas prices have moderated down quite significantly in 2023 from their all-time highs in 2022. And as we can see on this chart, this trend has been continuing in the first quarter of 2024, but then we also see that both Asian and European gas prices have almost doubled since their February lows and closed the 2024 year at around $15 per MMBTU, so standing well above their historic averages. And we believe that this strong increase in natural gas prices through 2024 has been very much supported by tightening market fundamentals. On the supply side, we have seen that LNG output increased by just a mere 2.5%, or in absolute terms, 13 BCM. Meanwhile, natural gas demand has been extremely strong, and it has been unexpectedly strong also in certain markets due to extreme weather events. And on the top of that, we had also seen that geopolitical tensions have been also providing upward pressure on natural gas prices. The second element I would like to draw your attention on is the shape of these lines, which shows that both Asian and European prices have been quite volatile over the course of 2024. In fact, TTF displayed a volatility of 50% above its historic average, and JKM's volatility stood 90% above its historic volatility. And this has been once again fueled by geopolitical tensions, uncertainties in the market, as well as extreme weather events such as sizzling summer heat waves. And the third aspect I think we should note here is the gray area in the chart, which shows the spread between JKM and TTF. This spread averaged at near $1 per MMBTU in 2024 and incentivized a higher increase in LNG imports towards Asia, which increased by about 9%. Meanwhile, Europe's LNG inflows declined by 18% in 2024. And as we can see at the right hand of the chart, this spread between JKM and TTF has been tightening in the last quarter of the year. And as we will discuss later on, we expect that in 2025, during the summer season, actually TTF will be trading at a premium compared to JKM. Now, in contrast with natural gas prices, LNG charter rates have been plummeting to all-time lows in recent weeks. We see on the right-hand chart here that the LNG spot charter rates are displaying quite a bit of volatility, and they have been in a steep decline since October 2023, when they averaged at just above $200,000 per day, and they have been declining to an average of 50,000 per day in 2024, and dropped to an all-time low of below 5,000 per day in January of this year, which is not even sufficient to cover the operating expenses of these vessels. And the reason for that is that LNG carrier capacity growth has been outpacing incremental LNG supply in 2024. As we mentioned previously, approximately 10 million tons of incremental LNG have been arriving to the market in 2024. And in contrast, there have been almost 70 new LNG carriers hitting the waters, which on an annualized basis translates into a LNG carrier capacity of almost 35 million tons. So there is at the moment an oversupply in LNG carrier capacity. And when we are looking at 2025, we expect that the LNG carrier fleet will increase by almost 90 new carriers, which is an all-time record in terms of new vessels hitting the waters. So despite all this price volatility, what we see is that the interplay between regional gas markets has continued to increase in 2024. On this chart, we are showing the correlation factor between TTF and JKM prices, which have been increasing from around 60% between 2013 and 2019 to an average of 90% since 2020, and hit an all-time high of 95% in 2024. So it means that the interplay between the Asian and the European markets is becoming increasingly intense. What happens in Asia is influencing Europe, and what happens in Europe is increasingly impacting the Asian price dynamics. And of course, this has been partly facilitated by the steep increase in flexible US LNG supplies, which now accounts for more than 1/5 of global trade and is expected to further increase this year as new projects are coming online. And I would also say that these very low LNG charter rates, spot LNG charter rates, have been also contributing to this higher correlation between TTF and JKM. Now, looking at the demand side, on this chart, we are presenting how natural gas consumption evolved in the key gas markets we are closely monitoring here at the agency, including Europe, Asia, the Americas, and Eurasia. And our estimates indicate that global gas demand increased by 2.8%, or just around 115 BCM in 2024. This marks a return to structural growth after 2 very difficult years. And I also have to say that our estimates indicate that natural gas alone accounted for about 40% of incremental energy demand, more than any other fuel. And as we can see on this chart, this relatively strong increase has been very much supported by the Asian markets, and Frederick will provide us with greater details on that. But maybe just to mention that both China and India displayed double-digit growth rates over the course of 2024. But we have also seen quite some increase in the Eurasian markets at above 3% year-on-year. And in the Americas, we have seen an increase of 1.7%, very much supported by the power sector. Meanwhile, in Europe, we have seen just a marginal increase compared to 2023. And from a sector perspective, our estimates indicate that industry and the energy sector have been the most important driver behind incremental gas demand and accounted for approximately 45% of the total growth. But we have also seen a rather robust increase in gas to power demand, which has been supported on one hand by the gas-rich markets of North America, Eurasia, and the Middle East. But also the extreme weather events we have seen have been contributing to that growth. And here I would like maybe to mention that we see not only a quantitative growth when it comes to natural gas markets, but we also see that there is a qualitative change. Natural gas is playing an increasingly important role in ensuring heat and electricity security in the wake of more extreme weather patterns, but also in markets which are increasingly reliant on variable weather-dependent renewables. And here on this chart, we are just presenting a couple of examples from 2024. In January of last year, winter storm Heather hit the United States and drove up natural gas demand to an all-time high of almost 4 BCM per day. And here, during that storm, we have seen that gas use in the residential and commercial sectors rose by 70% just in a few days' time. And during the same period, gas to power demand has also increased by 40%. And of course, the gas system has been very flexible, very reactive, partly supported by the vast underground storage facilities in the United States. But when we are looking at India, we have also seen that the sizzling heat waves, which have been hitting the country from May to July, increased gas to power demand by around 30% in order to meet a higher electricity demand amid the stronger cooling needs. And most of that additional natural gas demand have been met by flexible LNG supplies. And we have also the example of Brazil, which have been suffering from droughts, negatively impacting the hydro availability in the country. And as a consequence, we have seen that that gas-fired power generation increased by 600% between June and October, playing an essential role in backing up the electricity system. And of course, last but not least, in Europe, I think many people outside of Germany have been learning this German expression, Dunkelflaute, this November and this December, because indeed we have had days when we had a combined cold spell with relatively low wind speeds, which sharply increased the call on gas-fired power plants, and particularly in the first half of November, when gas-fired power generation increased by 80% year on year. And here again, the gas supply flexibility has been key to ensure electricity supply security, and underground storage facilities have been really playing a key role in delivering that gas supply flexibility. So I think when we are looking at all these examples, this tells us that we should be carefully considering the investments which are required in flexible gas assets in order also to ensure heat and electricity supply security across various markets. Now, moving to the supply side and also looking ahead of 2025, on this chart, we are showing what we expect in terms of incremental gas supply in 2025. First, LNG supply is expected to increase more strongly than in 2024. We expect a growth of 5% or just above 25 BCM. And this is very much supported by the startup of new major North American projects such as Plaquemines, Corpus Christi Stage 3 expansion, LNG Canada, and also Tortue FLNG in Africa. In addition to that, we expect that Russian pipe gas deliveries to China will increase by around 7 to 8 BCM through the Power of Siberia pipeline system. But some of that growth will be offset by the lower Russian pipe gas deliveries to Europe after the halt of the Ukrainian transit. So this could lead to a decline of approximately 15 BCM of Russian piped gas. And in addition, when we are looking at the European storage sites, we see that they are at the moment approximately 15 BCM below their last year levels, which also indicates that storage injection this summer could be significantly higher than what they had been in 2024. And of course, this would further tighten up market fundamentals. So these tighter market conditions are expected to have implications also on natural gas demand growth. And we expect that after the relatively strong increase in 2024, global gas demand growth will slow down to below 2% in 2025. And as we can see on this chart, once again, this is expected to very much supported by the rapidly growing Asian markets, where we expect a growth of just below 4%, and they would account for around 45% of incremental gas demand. We also expect that the Middle East and Eurasia combined will increase their gas demand by around 3%. Meanwhile, the more mature markets of Europe and the Americas will remain broadly flat compared to 2024. And in terms of sectoral perspective, we expect that the most important driver will remain industry and the energy sector. We also expect that gas use in the residential and commercial sectors will be higher than in 2024 on the assumption that we will return to more average weather conditions after the very mild patterns in 2024. But I have to say that in terms of gas to power demand, we expect that this would remain close to its 2024 levels, partly because of the higher gas price environment is expected to limit the cost competitiveness of gas-fired power generation against alternatives. With that, I would like us now to move to the European market. And here on this slide, we are just presenting how natural gas consumption evolved in Europe. Our estimates indicate that European gas demand increased by 0.5% in 2024, translating into an increment of 2.5 BCM. And as we can see on this chart, most of this growth has been really concentrated in the last quarter of the year, when natural gas consumption increased by 9% compared to 2023. But we also estimate that most of that gas demand growth in the last quarter has been weather related. We had colder weather, which incentivized higher gas usage in the residential and commercial sectors. And as mentioned previously, we had lower wind speeds, which led to a quite robust increase in gas-fired power generation. I also would like to draw your attention on the gray in this chart, which represents our estimates for industrial gas demand. Our first data suggests that gas use in the various industrial sectors increased by around 9% compared to 2023, but it remains well below the pre-crisis. And any further recovery is very much dependent on the price dynamics. And at the moment, when we are having a TTF price at around $50 per megawatt hours, it would be difficult to see any further recovery happening in the European industrial sector. So when we are looking at 2025, we expect that European gas demand will remain broadly flat. We expect an increase in residential and commercial gas consumption, simply based on the assumption that we will return to more 5-year average winter weather conditions. But this growth is expected to almost entirely offset by lower gas burn in the power sector, which we expect to decline by 10% amid the rapid expansion of renewables. On this slide, we are presenting the supply picture for Europe. And I think that the most important point here is that after 2 strong years of LNG imports, Europe reduced its LNG inflows by around 18% or 30 BCM in 2024. And this has been partly because of lower natural gas demand in the first half of the year. The second reason has been the lower storage injections. And the third one, the stronger piped gas supplies, both from Russia and Norway. So all these elements have been, in a way, squeezing out LNG from Europe, but still LNG retains its dominant position in the European gas supply mix, accounting for about 32% of the total gas supplies into Europe. Now, I think one very important element to look at is, of course, storage levels. And what we have seen that since the start of the current heating season, the European storage withdrawals have been extremely strong. They are standing as being the third highest since in the last 10 years. Altogether, there have been about 40 BCM of gas withdrawn from the storage facilities. And this is partly because we have seen this rather strong increase in natural gas demand. But at the same time, LNG inflows into Europe continued to decline in the last quarter of 2024. So because of these two elements, we have seen a stronger withdrawal rates from European storage sites. And of course, this is impacting on the fill levels. As we speak, the fill levels of European storage sites have dropped below 55% of their working capacity. And they are standing 6 BCM below their 5-year average and 16 BCM below their last year levels. So this means that over the summer, the injection requirements will be significantly higher compared to 2024. Our expectation is that approximately 10 BCM additional LNG approaches, 10 BCM of additional injections will be required throughout the summer. In addition to that, there will be lower pipe gas imports into Europe, mainly because of the halt of the Russian gas transit via Ukraine. And on the top of that, we also expect that European domestic production will continue to decline due to the aging North Sea fields in the UK continental shelf. Now, when we combine all these elements, we expect that Europe will increase its LNG imports through the summer period by at least 25% compared to 2024. And of course, this will have implications on prices. When we are looking at the current forward curves, they clearly suggest that the European premium is back on the market. TTF future contracts are trading at a clear premium compared to JKM, which is necessary for Europe to attract all this incremental LNG, which is indeed needed to fill up storage sites. But at the same time, this higher price environment could have also could renew the strains on the competitiveness of the gas and energy intensive industries in Europe. So with that, I would like to give the floor to my colleague, Frederick Ritter, who will give us an overview of the Asian market developments. Thank you.
Great. Thanks very much, Gergely, for handing over. So we've seen quite a bit of the global picture here, as well as a focus on Europe. And as you said, I think it'll be useful to continue this focus on certain segments of the markets, notably Asia and LNG. Both of these segments, I think, will be useful in painting the picture of our continued sort of rebalancing, if you will, in 2025. And also how the global gas market remains in somewhat of a fragile balance in our outlook, as we've said. So as a reminder, Asia Pacific is the main global gas demand driver, accounting for about 45% of incremental demand. This was the case in 2024, and we expect it to remain the case in 2025 as well. In the chart on the left, the black numbers at the top of the columns are the Asia-Pacific growth rates, and the gray numbers just within the columns are the global gas growth rates. This gives us a quick comparison of the region compared to the rest of the world. There's a net slowdown in growth in 2025 compared to 2024. This is something Gerge has alluded to here. China is the first factor here with less favorable economic fundamentals on the horizon. Mature Asian markets are also key here as well. After growth in 2024, which was somewhat exceptional as a whole, they're back on a trajectory of decline in 2025. Now, if we look at the chart on the right, this will give us a little bit more insight on this last point. The power sector is where we see the largest downgrade in growth year on year. Nuclear and renewables continue to eat into the residual load. This is a phenomenon we'll say in many regions, but very much so in Asia as well. Japan, notably, is among these more mature markets where nuclear is making gains, but also in China and India, where solar PV growth is strong and hydro generation is expected to stay at healthy levels after what proved to be a crucial recovery last year. Now, in this chart on the right, we also see that industry remains a significant chunk of demand upside in 2025. However, I think we just need to point out that many of these markets in the Pacific Basin are relatively price elastic, and some have viable fuel switching options. This is something that we saw play out during the 2022, or at least the peak of the supply crunch in 2022. So we know how this can operate. So while a good share of expected growth does hinge on industry demand growing, we need to keep in mind that under tighter market conditions, we'll talk about this in these risks, we'll say in a few slides, there is a degree of vulnerability to this incremental demand. Now, as we go in a little bit deeper in the region, let's start with China on the next slide. We'll get into the forecast on the following slides, but I think it's useful to come back to this chart that we've shown in the past. This is historical demand at a quarterly granularity. So remember the 2022 episode when demand took a hit during the global gas supply crunch and under COVID-related restrictions in China. This we see quite clearly on the chart. China then came back into a strong growth period from second quarter 23 through third quarter 24. So year-on-year demand growth, year-on-year by quarter, demand growth averaged around 10% over these quarters. This is remarkable growth, a period of recovery and moving into more fundamental growth into the next stage. But what we want to point out here is the significant slowdown in fourth quarter 2024, all the way on the right side of the chart. We are, of course, working with estimated data here, so the sectoral split may outturn differently. The net overall shift is likely to be different as well, but we see a clear change in dynamics towards the end of 2024. Demand growth is expected to have slowed to its lowest point in multiple quarters, and deciphering what's behind this could be an important indicator for the year to come and what we expect. Now, the first factor at play here is not so much about fundamentals. It's something that we've heard Gerge mention a couple times. It's weather. In November and December 2024, heating degree day values were much lower than in 2023, particularly looking at key provinces in China in the northeast, where gas use and heating is quite a bit more prevalent than in other areas. Now, a more fundamental factor here is the expected drop in industry sector natural gas demand. This is a notable turnaround from what China has experienced since 2023. For a while now, there's been talk of a slowdown in the building sector. In autumn 2024, there was also this announcement of a stimulus package, which ended up targeting more provincial government finances as opposed to being an injection of cash and subsidies, we'll say, support to the hard economy, if you will. And overall economic growth expectations have been down a notch for a little while. Not by any means weak, but slightly lower than previously expected at the beginning of 2024, for example. So there are signs that industrial and manufacturing activity is going through a period of relative uncertainty, and this could impact natural gas demand growth in the short term. Now, a further element here Also, something that Gergely alluded to is the fact that East Asian spot LNG prices have been at levels above $10 per MMBTU since June 2024, and even closer to $15 per MMBTU in fourth quarter 24. This is an extra source of pressure on importers and buyers. So overall, this is something we've flagged in the past, and we do see some signs of softness in fundamentals emerging. But that being said, there is significant momentum in Chinese energy markets. Of course, gas is not an exception. So while I've mentioned all these caveats, let's move to the next slide and see what exactly our view is for 2025. Now, two reminders to start us off here. China accounts for about 80% of Asian demand growth in 2025 and for about 36% of global gas demand growth. These are huge proportions of the incremental demand we expect coming on the market in this year. We forecast demand growth to be at just under 7% in 25, down from slightly above 8% in 2024. And this should add around 30 BCM of gas consumption in the year. This is growth across the board in all sectors. Industry, of course, remains the key driver, despite the slowdown that we saw in fourth quarter, with both a degree of fuel switching and organic growth in industry here. In the other category, I see that there is another question that just came up in the chat. Maybe I can address it right now. This other category is a couple of things. Of course, it's going to be sort of transmission and road sector transport as well. It's going to be energy sector own use, and of course losses. So it's a bit of a mixed bag. But I do want to point out here that this transport segment, road transport segment in other, while industry remains, a big driver, what we saw in 2024 is transport making quite a bit of growth and gains. These past couple of years in 23 and 2024, the sale of LNG powered heavy trucks jumped considerably as gas as a road fuel, or LNG as a road fuel, has participated in tapering a bit of diesel demand in the road sector. So what we expect is that gas is set for continued growth in the road sector in 2025. But as I mentioned in the previous slides, we do remain attentive to potential stumbling points in these dynamics. So relatively high international gas prices, slowing economic fundamentals, and of course, the potential for fuel switching in a few sectors. This is in industry, this is in transport, this is in electricity generation. We need to understand that there are some tipping points that can soften demand here. So coming back to the road transport sector, for example, monthly LNG truck sales have proven to be quite variable these past couple of years, notably with respect to the overarching LNG and gas price environment. So sales are likely to have been boosted these past couple of years by improving domestic price dynamics in 23 and 24, but trucking fleets can be highly reactive to changes in relative pricing dynamics. So just something to keep in mind. There is relatively, so there are solid fundamentals here, but we need to highlight some of the pressure points as we go into this year. Now, what does this all mean for the supply side of the picture? This is the right column in the chart on the left. Domestic production is set to account for the largest share of supply growth, slightly down compared to incremental volumes in 2024, but still we're talking about significant volumes here. Just as background, China saw an acceleration in its domestic production around 2017, with growth averaging around 7 to 8% per year since then. This is significant growth in domestic production. Rates have tailed off to around 6% more recently, but the additional volumes per year have remained definitely significant. The second aspect here is the maximizing of the capacity on the Power of Siberia line from Russia. This should bring around 70 extra BCM into the Chinese market as the completion of the final connections in the Shanghai area in late 2024 allow deliveries to reach their total nameplate capacity of around 38 BCM in 2025. And then finally, there are LNG imports. And I admit this is a bit of an odd way to phrase things when we consider that China is the #1 LNG importing market globally. Of course, China remains a huge buyer of LNG, but we expect Chinese LNG import growth to slow down considerably in 2025. We'll get to the broader LNG picture in a couple of slides, but we see LNG imports acting as the balancing factor in the Chinese market. And conversely, we'll get to this in the next section, but China and Asia more broadly could be playing a growing balancing role in the LNG market, vice versa. So before we move to India and other emerging Asia in the next slide, I think we can have a quick look on the chart on the right. We see that China again became the world's largest LNG importer in 2024, although volumes remained slightly below their 2021 peak. A small note here as well on the other Asia Pacific, outside of these larger individual markets like China and India. Collectively, these smaller markets, if we group their imports together, these are set to surpass Japanese imports in 2025. Let's keep this in mind as we move to the next slide and we talk about the other Asia Pacific forecast. So we're focusing here on the other growth elements in Asia. That's mainly India and the broad grouping of other emerging Asia. As we've said in the past, these are markets with varied consumption profiles, varied supply mixes, but thinking about them and their similarities at least can help or can at least prove useful in understanding how they can reach or how can they react, to the global gas market fundamentals and how they can even shape them in certain instances. Now, the big difference between India and these other emerging Asia grouping is the main driver of demand. In India, we're talking about industry. This is broad industrial base refining applications that are driving demand. In other emerging Asian markets, we're talking about power generation being the larger driver. Now, while fundamentals point to continued growth, again, these are markets where the potential for fuel switching, the growing reliance on LNG in the supply mix can act as downside risks to the outlook. In fact, demand growth is expected to outturn a bit lower than last year due to stronger global gas demand and stronger headwinds, we'll say, in the broader market. Now, the dot above the columns shows incremental gas demand in 2024. We see how incremental volumes are down, are expected to be down in 2025. Demand is set to grow around 8% in India and around 2.5% in these other emerging Asia group. Again, global gas price benchmarks remain lower than where they were at the height of the crisis, but they have been on an increasing trend since second quarter 24. And at over $10 per MMBTU, around the $15 mark, they can put pressure on the outlook for LNG buying in Asia. So while demand growth in these markets generally leads to a larger call on the LNG market in our outlook, global LNG market fundamentals will also condition the rate of buying in these markets. Now, this brings us to the broader LNG balance. I've already made a few references to how we see the market in 2025 on the next slide, but let's take a closer look starting with the supply picture. So on the next slide, we see that 2025 is clearly an important year. This is how I think we can introduce it. We expect incremental LNG supply to double compared to what we saw in 2024. We're looking at around 26 BCM of extra LNG on the market, coming almost entirely from North America. Now, this doubling seems substantial, of course, but it is compared to two lackluster years of supply growth in 2023 and 2024, years where, number one, there weren't that many new liquefaction projects coming online, and number two, where downside at existing plants essentially discounted the net growth of the market. In 2024, for example, just as an example, we saw Egyptian LNG exports dry up completely, while Russian export growth was somewhat constrained by sanctions on Arctic LNG 2 project. In 2025, we have more new capacity coming online. This is, of course, in the US. Gerge has mentioned it. Plaquemines that started in the last days of 2024 ramping up. There's a Corpus Christi expansion progressively coming online with small incremental trains throughout the year. And Altamira project in Mexico is expected to move to full utilization after a start in August 2024. LNG Canada starting in the later part of the first half of this year. Outside of North America, of course, there are projects in Africa. We're talking about the Greater Tortue project in Senegal and Mauritania, 2 FLNGs in Congo as well. And of course, there is upside coming from Freeport LNG in the US, recovering from outages that happened in the first half of 2024. Now, taken together, this is a considerable amount of incremental capacity on the market in 2025, but a lot of this supply growth will be dependent on ramp-up trajectories. So will projects start on time? We've already seen a number of these projects delaying their targeted start dates into 2025 and even later. How quickly will projects get to the 80 to 90% capacity factors? First cargo is one thing, but a rapid move to full utilization is another thing. Of course, there is still a degree of upside risks to our outlook. Sorry, with respect to ramping up of new production at new projects, of course, but also with respect to potential feed gas and utilization improvements at existing projects. Malaysia and Nigeria are notable examples of this latter factor. It's good to keep this in mind. There could be a little bit of upside. Now, one more development that I think we need to mention here from earlier this month that has come into play is the new US sanctions targeting Russia's two smaller scale liquefaction projects, Vysotsk and Portovaya, both on the Atlantic Basin. So together, these plants exported around 3 BCM of gas in 2024, and we expect these sanctions to highly curtail both projects this year. So this is the supply picture that we build when we combine these elements. I'd say it's one of cautious optimism. We're on a better trajectory, of course, than last year, but project operations will be a key factor in delivering this incremental supply this year. Now, on the next slide, I think the import side of the equation will give us what we need to understand the global balance. I do see there's just one question on Congo and getting these two FLNGs online. It's a question asking, recent societal developments play a role there. Of course, there's always political risks in some of these projects, but we do see generally these two projects, one of which has already started being on track to deliver volumes in 2025. So on this final slide here of the LNG demand forecast, as a framing point, I think we need to understand that we see a shift to much more cross-basin competition for LNG volumes in 2025 compared to 2024. So I think this is a high-level message that we need to keep in mind. In 2024, we had limited LNG supply growth, and the market balanced with Europe reducing its imports by a sharp 18% and Asia mopping up these volumes. Spot LNG prices were relatively subdued in the first part of the year, leading to markets, both large ones and small ones, ramping up their buying. Now, in 2025, we're moving towards more competition between the Atlantic and Pacific basins. And at the heart of this is the European gas balance. Gergely has covered this already. Russian pipeline volumes to Europe are expected to be down. European storage fill is currently quite a bit lower than it was this time last year. And this means that filling requirements through the rest of the year will grow. Broadly speaking, the European balance is tighter than where it was 1 year ago. And as a result, we see European LNG imports growing significantly in 2025 by around 16% in our outlook. Europe is not the balancing factor in today's LNG market. The European market, much like in 2022, is set to actually condition the global market, while the Asian markets tend to be a little bit closer to a balancing role in 2025. Now, we're not seeing the end of import growth, of course, in the Pacific Basin, but growth is set to slow down significantly, to around 2% compared to 9% last year. So broadly speaking, I think we can say that incremental supply on the market in 2025 will not have a hard time finding a home. So this gives us what we could describe as a delicate market balance for the year ahead. Supply growth is accelerating, and there could be some upside factors. But a tight European balance and growth momentum in Asia essentially means that market fundamentals are on edge. And in situations like these, small mishaps can have outsized effects. Now, I think this closes out the LNG section, but I think I'll take just maybe one quick minute to discuss the last slide to cover some of our key takeaways. So just here to close things off, coming back to 2024, global gas demand returned to structural growth. This is a key point. Preliminary data suggests 2.8% growth for the year, supported by mostly the fast-growing Asian markets and, of course, the industrial sector. What we saw is that extreme weather events highlight the crucial flexibility role of natural gas, including in renewables-rich markets where gas-fired power plants help back up non-dispatchable renewables. I think the key point behind this is that While in geographies like Europe, we may be consuming a little bit less gas in sectors like power, the power sector is no longer necessarily a source of flexibility for demand, but it's actually a source more of volatility for gas demand. This is something to keep in mind when looking forward. Now, moving to 2025, global gas demand growth is forecast to slow down to below 2% amid tighter market fundamentals. Again, Asia remains a key factor here, but demand in this area in this geography is slowing down to below 4%. The next point, strong storage withdrawals and lower Russian pipeline gas deliveries to Europe means that we have a tighter European balance. And this is a key point for the rest of the market balance. LNG supply growth accelerates, but a tighter European balance leads to increased cross-basin competition, keeping global gas markets on edge. And under these market conditions, the global gas market remains prone to volatility. It has few flexibility options. And in the case of any unexpected supply-side disruptions, we can see a bit more volatility than hoped for. So on this note, I think we'll close it off and we'll open to questions that we might have in the chat.
Thank you very much. It was again very interesting, and there are also several positive notes in the chat about the high quality of the presentation. Thank you also for already answering some questions. There is another one of understanding for you, Gergely. Which countries do you enclose into Eurasia?
Yeah, thank you, Charlie, and many thanks for the question. Eurasia is defined as Russia, Central Asia, and the countries of the Caucasus. Of course, the dynamics of the region are very much influenced on what is happening in Russia, which accounts for the majority of natural gas production and consumption in that region.
Mm-hmm. There's another question regarding Russia. Where will the surplus Russian gas exports, power of Siberia minus loss on Ukrainian, end up?
Yes, and this is an excellent question. So maybe just to give some context for us, in Russian gas production declined by almost 20% between 2021 and 2023. But then in 2024, we have seen some recovery. Our preliminary numbers suggest that Russian gas output increased by around 7% in 2024. But of course, it is standing still well below the pre-crisis levels. For 25, we expect a marginal increase in Russian gas output, and most of that is actually concentrated in the eastern part of the country to scale up further the piped gas deliveries towards China. When we are looking at the western part of Russia, I think that here we basically, of course, expect less piped gas exports to Europe due to the halt of the Ukrainian transit. And as mentioned by Frederick, there are also, there are clear risks that also LNG exports from some of the medium-sized LNG facilities will be halted. Now, where this additional or spare capacity could go, what we have seen is that Gazprom has engaged in a very aggressive gasification program in Russia, so connecting new households to the grid. So basically boosting domestic gas consumption. We have also seen that in Russia, electricity demand is rather strong, and this is potentially partly because of the various industrial activities supporting the war. And I think that a third factor we should mention here is that Russia is also looking at new ways of boosting its exports towards Central Asia, including Uzbekistan, which is facing a structural shortfall in its gas balance. Then, of course, there could be a question mark whether those exports towards certain Central Asian countries could serve indirectly exports towards China, which I think is also looked at as a potential outlet in Russia.
Okay. Another question, how do you see the chances of the summer-winter spread becoming positive again in Q2 and Q3 2025? What would have to happen for such a change?
So basically the question, so to make sure that I understand correctly, the question means whether we could see that the 2025-26 winter contracts will be again trading at a premium to the 2025 summer contracts, which at the moment is not the case. I think that for that to happen, we would need that the premium disappears, so that the summer contracts decline quite rapidly. That could be maybe two key drivers for that. One is that if the storage withdrawals slow down very quickly, maybe because of weather events, so milder weather in the remainder of the heating season could slow down storage withdrawals, and of course this could depress the summer 2025 contracts. The second is improved outlook in terms of natural gas supply for the summer 25, and this could mean, of course, a more rapid than expected scale up of new LNG supply, so a quicker ramp up of new liquefaction facilities in the United States. On that front, what we see is that Plaquemines LNG phase 1 is ramping up quite quickly its deliveries. It remains to be seen what will be the exact timeline for Corpus Christi Stage 3 and for LNG Canada, which haven't produced or haven't delivered any LNG cargoes yet. And of course, I think that there could be also scenarios in which there would be an improvement in pipe gas supplies into Europe, including from the east. At the moment, we are not looking at such scenarios, because they seems to be very unlikely in the current unfortunate situation with Russia's invasion of Ukraine.
And then there are two short questions remaining. One is the weak German industry performance seen for 2025 already factored into the forecast?
Indeed. So, as mentioned during the presentation, we expect a very marginal increase in European industrial gas use. But to be honest, since we did the modeling, the price environment has worsened, and this seems to be increasingly unlikely. And of course, this has also implication on the performance of the industry of various national markets, including the one in Germany. So yes, this is factored in.
And Frederick, you also mentioned the other category a few minutes ago. Now there's a question: how large is the share of transportation in the others volume?
Yeah, so I think we are referring to particularly China here, so the incremental demand here in 2025, about 2/3 of that other section would be transport sector.
Okay, and then let me give you the last question for today. What will be the overall effects of the shutdown of natural gas transit by Ukraine to some East European countries on the EU gas and power market development?
No, thank you for that question. So our assumption on the Ukrainian transit since mid 2023 has been that we don't expect it to continue after the 1st of January 25, which of course happened. We don't expect this to have any imminent gas supply security impacts on EU member countries. But as we mentioned throughout the presentation, it is naturally leading to a tighter European and, as a consequence, to a tighter global gas balance. And of course, we have seen that in Moldova, in Transnistria, this has led to electricity and heat supply issues, which are at the moment through greater international collaboration and cooperation are being new supplies are being at the moment facilitated towards these markets. But of course, as we also highlighted in our reports, they are in a particularly vulnerable situation.
Okay. Thank you, Frederick and Gerge. Thank you very much for these fruitful insights in the international gas market. We are looking forward to the next report in 3 months. It was very interesting today. Und auch an Sie, meine lieben Zuschauerinnen und Zuschauer, vielen Dank für Ihr Interesse und Ihre Fragen. Wir werden Ihnen die Präsentation und den Report im Nachgang zu dieser Veranstaltung zusenden und die Aufzeichnung finden Sie ebenfalls zeitnah auf unserem YouTube-Kanal. Ich wünsche Ihnen noch einen guten Tag und eine erfolgreiche Restwoche. Bleiben Sie gesund und bis zum nächsten Mal.